Happy New Year, everyone. Welcome back to our video series. We are going to be going over the 2026 important numbers. It's one of our most popular videos every single year, gets the most views, so we're hoping that you're finding value in it. And we're going to provide a link so you can download the PDF and follow along if you'd like. For the most part, we're kind of working our way from the front page to the back, left to right. So feel free to pause the video and download that if you'd like to see the numbers along the way. We're also going to put some slides up so you can see the details too. But first, we also covered some of this in our video last year on the new tax law that got passed in July, so you might go look at that one. Of course, these numbers are going to be slightly updated for the COLAs given for 2026. But we're going to start with the income tax brackets for this year. Again, we're going to put on the slides the brackets from last year and this year. And it's important to remember with this, this is your taxable income number, not your gross income number. And so if you look on your tax return, there's a line kind of further down after you've had your deductions that's referred to as taxable income. And they're progressive. So for instance, married filing joint couple, the first $24,800, you pay 10% tax. And then you go into the 12% bracket and so forth as your income falls into those different ranges. But the brackets pretty much stayed the same. Again, inflated it a little bit just so that there's not tax creep with inflation, for instance.
Next up, John was talking about marginal rates, is long-term capital gains rates. So long-term meaning if you've held an investment for over a year, it gets preferential tax treatment. Under a year, it's taxed as short-term capital gain, which is the same as those ordinary income tax brackets. But you'll see the long-term rates are definitely favorable. So this is investments held over a year in addition to qualified dividends. So dividends that get that special tax treatment as well. And if you look, for instance, married filing joint, the first almost 99,000 of long-term capital gain can be at 0%. Now, it factors in your other income.
That assumes you don't have any other income.
Right. So if you had zero other income, you could sell almost 100,000 of gain and pay zero tax on it.
But the other income pushes you through it. So if you had like 50,000 of other income, then your capital gains, well, it's that difference from 50 to 98.9 that you're in the 0%.
Right. So 49,000 tax free. So you'll see for married filing joint again, you don't reach the highest long-term capital gain rate of 20% until you're over 614,000 of income. One more tax to note, you'll see the single is roughly half at 0%, and then a little bit different on the brackets. In addition to these rates is the net investment income tax, and that's 3.8%. That kicks in for married filing joint at 250,000, single at 200,000. So you can almost think of it as, yes, zero's the best, then 15, but you could quickly hit, what would it be, 18.8, and then at the top, 23.8 when you think of what's the total tax on that. So something to be aware of.
Next, we're looking at the child tax credits for this year. For under age 17, the credit amount is $2,200 or $1,700 of that can be a refundable tax credit. But there is a phase-out range, and this is something we mentioned with the tax video last July. A lot of what we're going over today is now subject to more phase-out ranges, so it makes it even more complicated because you have to remember not only what is the deduction or credit, but are you eligible based on your income?
Right. They almost could have called it the great phase-out rather than the one big beautiful bill, because you'll see on these slides, on the second column, it shows all these phase-out ranges for everything we're talking about.
Just the great complication.
That too. That's always the case.
And then, yeah, child and dependent care expenses, that's on the slide as well. If you have any questions about those, feel free to reach out if they're pertinent to you.
The standard deduction went up. So for married filing joint, so again, you can either itemize your deductions or take the standard deduction, whichever is higher. So for married filing joint, standard deduction $32,200, single is half of that, $16,100. But if you are 65 or older, you get an extra $1,650 or blind. So that would be on top of that. So the standard deduction is significant. When they doubled it years ago, a lot less people would itemize. So when we're looking through strategies, whether it's when to pay property tax or how you're charitably giving, that large standard deduction is significant because we may want to do a couple things in one year and take a big standard the next year, but something to be aware of there.
Also, if you're over 65 this year.
So one more, when we're talking about over 65, one more new deduction is a special senior deduction of an additional $6,000 that would reduce your gross income and getting to a lower taxable income number. You'll see the phase out ranges there again. It fully phases out at 175,000 if you're single, 250 married filing joint. So John, tell me about itemized deductions.
The main difference well, there are probably two big differences in itemized deductions this year. The first, as it relates to what we call the SALT deduction, which is state and local tax. So this is how much you can deduct if you're paying income taxes and/or sales tax, as well as property tax. And previously that got capped at $10,000, so it was very punitive, especially for states that have high income tax. This year, they've increased that a little bit, or a decent amount. It can go up to $40,400. However, there is a phase-out range. So, single or married filing joint, is your income gets over $505,000, you begin to get back down to that cap of $10,000. Once you're over $605,000, you're back to that $10,000 cap. So, good to keep an eye on that. And then also, kind of a surprise for this year is the charitable contribution floor. Was surprised that they put this in because normally they don't want to mess with the incentive to give charitably, but you now essentially have a floor. 0.5% of your adjusted gross income gets taken off your charitable deduction. So if your adjusted gross income is $100,000, let's say you've given $5,000 to charity, well, that 0.5% is a $500 floor, so you're only getting to deduct $4,500 of your $5,000. So again, this can be important, especially if your income is high. It really might encourage you to bunch your deductions, like Andrew was saying, take more one year and not the next.
Yep. So with itemized, we're talking about medical expenses, although that has to be over 7.5% of your adjusted gross income. State and local tax, so sales, property tax, state income tax if you have it, mortgage interest, and then charitable. So all of that has to be over those standard numbers. There's also, they're adding back, they had this a few years ago, but even if you take the standard deduction, you can get an additional charitable deduction. Let's see, I believe it is
$1,000 for an individual, $2,000 for married filing joint.
Yes, so that would be like if it were $32,200 standard deduction, it could be up to $34,200 married filing joint. Has to be cash, so it can't be goodwill. It has to be a cash donation. There's a few other new from the tax law passed last year. Some other deductions. Again, be aware of the phase outs. But this is tax on overtime and tips. There is now a deduction on those up to $12,500 for overtime single, $25,000 married filing joint, and then tips $25,000 single or married filing joint. So these will certainly help those that have overtime or tip income under those phase out thresholds. And one other to be aware of, car loan interest. So up to $10,000 deductible on U.S. assembled vehicles under those phase out numbers. It's interesting. The phase out income, if you are paying this much interest on a new vehicle at this income level, you're borrowing a lot. But if you're getting that full $10,000 deduction, but something to be aware of.
We're not going to touch too much on the education credits. I mean, if you think you're, maybe eligible for some of those, call us. We'll talk to you about it if they get a little complicated. But the estate and gift tax, the lifetime exemption for your estate is now $15 million. That's per person. So a married couple could have up to $30 million to leave to their children. and there will be no estate tax owed on that. Um, it's yeah, been growing, and at one point when we started, it was like $1 million. So you had to
Hmm.
be really mindful of it. The the tax rate, if you go over that, is pretty quickly 40%. So
Yeah.
it's definitely something to be mindful of, especially if you think you've got a asset that could dramatically increase in the future. You might want to go ahead and do some planning on that. And then the annual gift exclusion is $19,000. So that is the amount you can give to somebody, and that's per person per year. So you and your spouse could each give one of your children 38,000 because it's 19 each, and you don't have to file any special tax returns for that. If you go over that, either you have to use some of that 15 million lifetime exemption or pay a gift tax. So it's important to keep that in mind because you would have to file a special tax return to document that.
Yeah, that would go against that lifetime limit. The 15 million per person, also to note, if you're married, one spouse doesn't use theirs, it's portable to where you file Form 706.
Yes, I think so.
I think
Or
so.
is that the estate? That's the estate one.
You file a tax form to document that you were using their um, their estate tax exemption as well. So that's the portability.
Sorry,
Um,
Andrew, I stole you were supposed to talk about the gift tax.
you did. You did.
I was
Okay.
just so eager. They go to hand in
I
hand.
know. All right. I'm going to steal yours or at least start the next one.
Go for it.
So, retirement account contribution limits. We, of course, are always tracking these and encouraging clients to max out as many tax deferred, tax preferential retirement accounts. Um, they ticked up a little bit. So the 401k deferral limit is 24,500. You get an additional 8,000 if you're over 50. And now there's another small window. If you're age 60 to 63, instead of that 8, you get 11,250.
It's called the super catch up.
The super catch up. Now, the total that you can put into a 401k between your deferral, employer contributions, and then even over and above after tax contributions is 72,000. And I believe over 50, that would be 80,000. Yeah.
And it's important to keep this in mind, especially if you change jobs mid-year. I mean, most employers will monitor this. If you're going over the 24,500, they'll cut you off or refund it. Of course, if you start working with one company at the beginning of the year and change companies, they're not going to know how much you did,
Hmm.
and there can be some penalties if you don't get that corrected. So, actually, I ran into that with a couple of clients last year that we had to be mindful of it. And,
Right. They
yeah.
have two 401k plans, but it's one
Yep.
dollar amount.
Right, for the whole year. So good to keep an eye on that.
Now, if you have a 401k, one job, and you also have your own small business, consulting, whatever it is, you can max out the 401k and contribute to a SEP IRA. Um, those being two separate retirement plans for two different businesses.
Hmm.
So we were going to touch quickly on the SEP contribution limit. Um, it's up to 72,000. Now, there's rules around this, but think of it roughly as 20% of your net income. So you're self-employed, you have all your revenue, all your expenses you can deduct, which are um, lengthy when it comes to being self-employed. That net number, take 20% of that, and that's roughly your contribution limit.
You can confirm it when your tax return is prepared. And
Right.
of course, you have until October the 15th if you extend your tax return to make this contribution. So plenty of time. But
That's right.
yeah. Let's see, IRA and Roth contributions, they slightly increased. The limit this year is 7,500, and then they're confusing us more on the catch up. It used to be an even $1,000, now it is $1,100. So if you're over 50, you can do a total of $8,600.
Hmm.
And both of these have income limits to be aware of as well. So if you're trying to contribute to a Roth, you need to be aware of the phase out. If you're filing as an individual, once you start reaching 153,000, or if you're married filing joint, it's called your MAGI, modified adjusted gross income, reaches 242,000, you may not be able to make that full Roth contribution. So if you're approaching that, you need to be aware of it. I always tell folks if you've made a Roth contribution, make sure to tell your tax preparer because they can be aware and tell you, hey, you might have been over, you need to remove it.
Right. And that'd be
Um,
directly into the Roth. We often use a backdoor workaround to get around that income limitation, but there's some nuances to that.
we have a video on that as well.
And we do. The library is
Growing.
it is growing.
And then, yeah, and that's really related to the traditional IRA phase out. If you're trying to put money into a pre-tax IRA and you want that deduction, you possibly can, but if you're working and you're contributing to a retirement plan, they limit whether you're able to deduct it or not based upon your income there. So, again, sometimes we intentionally do that to do the back door if somebody's not able to contribute to their Roth because of their income.
And one last, when it comes to Roth, pre-tax, et cetera, one more note on 401ks. That catch-up contribution of 8,000. There's now a new rule that if you're over 145,000 of income, that has to be Roth. It can't be pre-tax. So those would be after-tax dollars contributed. Your 401k provider should be giving you documentation on this, but you can't then put in 32,500 pre-tax over 50. It would be 24.5 max the pre-tax, and then 8 after-tax into Roth.
It's still good to do. You're going
Yeah,
to be paying your income tax either way, so you might as well have the opportunity to shelter it inside of a Roth so it grows tax-free in the future.
absolutely. Yes, if you can max it out, it's a great way to diversify the types of savings that you have. Social Security, the dollar amount that you pay Social Security tax on ticks up every year. It is 184,500 for 2026. There was a 2.8% cost of living increase in your Social Security benefit this year. So you may have seen, if you've gotten your January Social Security payment, it tick up a little bit. John's going to touch on what could have made it come down a little bit. Medicare premiums are also deducted, so those change every year. And then, let's see, if you take Social Security before your full retirement age, whether that's 66, for most now it's 67, and you are also working and have earned income, there is a phase out to where they may not pay it because your income's over a certain threshold. So you'll see those on where those start to phase out. And then, let's see, you also, your Social Security may be taxable if your income is over a certain amount. So you'll see that on the slide as well.
The provisional income section?
Right.
Yeah, basically, if Social Security were your only income in retirement, you wouldn't pay any tax on it. It's 0% would be included as taxable income, but as your income goes higher, then yeah, as much as 85% can be included as taxable income. Medicare premiums and IRMAA surcharges. The Medicare Part B premium this year is going to $202.90 per month. And then there is IRMAA, IRMAA, stands for Income Related Monthly Adjustment Amount. We dove into this a lot on our Medicare discussion last fall with Margaret, so a lot of good information there. But yeah, it's basically just depending upon your income from 2 years ago. So in 2026, they're looking at your 2024 tax return. If your income was over these different thresholds, they're going to tack on an extra premium, not only for your Part B of Medicare, but also for your drug plan. Now that's a year-by-year thing, and especially if, say, you retired in 2025, maybe the end of 2025, and you started Medicare this year, there is a way to get that removed because there is something called a life-changing event form that you can file and say, look, I know my 2024 income was put me at a level where I was subject to this. However, I've had a life-changing event, retirement being one of them. So this year, please don't charge me that because I expect my income to be lower. You can even get it refunded if you don't realize that until like June. You can submit the form, they'll refund you for the year. But it all gets reconciled when you file your next tax return. Right. So, don't think you're going to game the system. Although they won't refund you if you paid it and you didn't have to.
Yeah.
So you do want to make sure you're on it for that.
Right. Yep. Rather take it and then owe it later than never get it at all.
Right.
Last thing, one of our favorite types of accounts, health savings account. So if you have a high deductible health insurance plan, you'll see those are the minimum annual deductible, max out-of-pocket thresholds to meet this. You can put money tax-free into a health savings account. You can then pull the money out tax-free if used for qualified medical expenses, which are extensive. I mean, you can pay for Medicare premiums later on, long-term care, therapy. I mean, you name it, you can pull up the list. It's on there as it relates to medical. A lot of HSA plans also allow you to invest the money while in the account. So they may require you to keep $1,000 in cash, but you can invest the rest. So you are getting triple tax beneficial treatment on this. This is why if you have an HSA eligible plan, we strongly recommend you max it out. And in an ideal world, you max it out every year and you don't use it. You pay out of pocket your medical expenses. And then when you do retire, you've got a significant tax-free medical bucket to draw from.
You can't go wrong with it either, because once you're 65, if you needed to withdraw from it for something other than a qualified medical expense, you can. You have to pay income tax on the earnings. That's exactly like a regular 401k account. So it's just a really good all-around account to have and to grow. And yeah, it's great. It's also important to know. I mean, if you're working somewhere and you opened up your HSA with that company's job, they might require you to have your HSA there. So if it's a payroll deduction, you also avoid Social Security, Medicare tax. So yeah, it's great. But once you leave a job, you can transfer your HSA to, there are other custodians.
Yeah.
If you don't like the HSA plan that you're in, just know there's some flexibility there after you stop working.
Right, and it's yours forever. There is no use it or lose it. We didn't touch on flexible spending account, FSA, but that is, I think it's $660, $680.
80.
680.
It says right there.
I was trying to go from up here. That's the only amount that you can roll over year to year. So more restrictive. HSA, it's yours forever. Great vehicles. So we haven't covered everything, but we hit a lot of the highlights. We know it's a lot of numbers and a lot of rules. So always feel free to reach out to discuss your personal situation. But this is, I think, one of our favorite videos of the year. Really great info. So hope it was helpful to you.
Pass it along if you know someone else that might benefit from hearing it. Thank you.